All right, everyone. In this video, I'm going to go over the metrics that I'm going to use to evaluate the businesses that I already have in my portfolios. So, including this one, Apple. Not so much the ETFs, but the actual individual businesses. So, all these businesses, I'm going to evaluate based on the teachings of Peter Lynch from his book, One Up on Wall Street. So I'm going to go over the notes that I'm going to use to screen each one of these stocks and any potential stocks that I plan to own in the future. So let me pull that up. So here are the notes that I took regarding Peter Lynch's One Up on Wall Street. Again, this isn't the end-all be-all for evaluating a business. This is just some notes that I took and how I plan to screen the stocks that I already own in my portfolio and any future stocks. So starting off is the size of the company. I'm going to use revenue as the metric for determining the size. You could use market cap. I just think revenue is better because it's tied to the actual value of the business, because it tracks the sales as opposed to the market cap, which just goes based off the share price. So share price can plummet or it can skyrocket, and that's not necessarily tied to the actual value. It's more tied to the sentiment behind the business. But moving forward, we got these 6 categories that Peter Lynch talks about. I'm going to run through this video kind of fast. I don't want to make it too long, so I apologize if I go pretty quick. But starting off with the slow grower, it's a company whose growth is slightly faster than GNP, which is gross national product. In the book at the time, the GNP was about 3%. I'm not sure what it is today. This might be outdated. If anybody knows, feel free to leave it in the comment section. And slow grower usually or generally pay a regular dividend. Then we have a stalwart, multi-billion-dollar hulks, 10 to 12% growth in annual earnings. So anytime we talk about growth, we're talking about the earnings. Again, this might be outdated, but at the time, stocks like Coca-Cola, Procter & Gamble, and Bristol-Myers were considered stalwarts. Peter Lynch says if it's up 50% in a year or two, consider selling. Generally bought for a 30 to 50% gain, then sold to repeat the process with other stalwarts. They offer good protection during recession. Next category we got is a fast grower. This is a small, aggressive new enterprise, 20 to 25% in annual growth. It does not have to be in a fast-growing industry. It can take market share or expand into new markets. Look for companies with good balance sheets and making substantial profits. Next, we got the cyclical, which is a business whose sales and profits rise and fall in regular or predictable fashion, i.e. autos, airlines, chemicals, steel. I'm sure there's others, but those are some of the ones he named. He says that they're best when coming out of a recession, and timing is everything with these. Up next is a turnaround. This is a battered, depressed, Chapter 11, no growers, potential fatalities. And he gives some examples such as there's a bail us out or else, who would have thunk it, the little problem we didn't anticipate, a perfectly good company inside a bankrupt company, and restructuring to maximize shareholders' values. And last but not least, we got asset plays. So asset plays are businesses that are sitting on something valuable you know about, but Wall Street has overlooked it. Assets could be cash, properties, land, patents, subscriptions, etc. And then next we have, it has one or all of the following attributes. It's a dull or boring, ridiculous name. It does something dull. It does something disagreeable. It's a spin-off. Institutions don't own it, and analysts don't follow it. Rumors abound it's involved with toxic waste and or the mafia. There's something depressing about it. It's a no-growth industry. It's got a niche. People have to keep buying it. It's a user of technology. Insiders are buying and buying back shares. So Peter Lynch isn't saying that in order for you to invest, it has to have every one of these attributes. These are just favorable attributes that he likes to see in a business and a potential investment that he's going to make. But it's not necessarily, if it doesn't meet every one of these, or if it doesn't have every one of these attributes, don't invest in it. That's not at all what he's trying to say. Up next, we have stocks to avoid. So the hottest stock in the hottest industry, the next of something, diversifications, which are bad acquisitions in lieu of share buybacks or raising dividend. Whisper stocks, it's a great story, but it has no substance. The middleman, company that sells majority of its wares to a single customer, and an exciting name. Again, probably with the same idea. It may, have one of these, but it doesn't mean to not invest in it. You got to look at the fundamentals of the business. But these are, if it's the hottest stock in the hottest industry, people are just probably going to not look at it. Moving on to the next note, number 5, value businesses based on earnings or assets, and check the historical price to earnings ratio to see what's normal for the business compared to the industry and to itself. Then we have find out how a company plans to increase earnings and check periodically to see if the plans are working out. Number 7, develop the story. He calls it the 2-minute drill. What is the company going to add? What is the company doing to add prosperity, growth spurt, or whatever happy event is expected? What has to happen for the company to succeed, and what are the pitfalls standing in the way? And then here are some examples for each type of category. So if it's a slow grower, the 2-minute drill might be something along the lines of, presumably you're in it for the dividend. A possible script could be, the company has increased earnings every year for the past 10, has an attractive yield, never reduced or suspended dividends, and it's raised dividends. For a cyclical, the script revolves around business conditions, inventories, and prices. A 3-year slump in the auto industry, but now car sales are up across the board, new models are selling well, closed off inefficient plants, cut 20% of labor costs, and earnings are about to turn sharply higher. If it's an asset play, what are the assets? How much are they worth? Insiders are buying, the company has steady earnings, and there's no debt. For a turnaround, has the company gone about improving its fortunes, and is the plan working? Are they buying back shares? Increased market share? Earnings are up. For stalwarts, the key issues are the PE ratio, whether the stock has already had a dramatic run-up in price in recent months, and what's being done to accelerate the growth rate. The example he gives here is Coca-Cola is selling at the low end of its PE range. So the stock hasn't gone anywhere for 2 years, sold half its interest in Columbia Pictures. Japanese and Spanish consumed 36 and 26% more Coke, and the company has bought out many of its independent distributors. And for a fast grower, where and how can it continue to grow fast? La Quinta Motel started in Texas and was successful in Arkansas and Louisiana. It added 20% more motels than last year. Earnings have increased every quarter, planned rapid future expansion. That is not excessive. Motels are a low-growth industry, but La Quinta has a niche. Number 8, all information you need can be found in the 10K, the 10Q, or proxy statements. You can also call investor relations. Number 9, visit HQ or attend annual meetings to develop useful contacts. Number 10, kicking the tires. Wandering around stores and tasting things is a fundamental investing strategy, not a substitute for asking key questions though. Number 11, reading the balance sheet. Add cash and cash equivalents and marketable securities to get overall cash position. Is cash more or less than last year? Review long-term debt. Has it gone up or down? When cash increases relative to debt, it's an improving balance sheet. Other way around, deteriorating. Subtract long-term debt from cash to get net cash position. Very favorable when cash exceeds debt. You can ignore short-term debt. It's safe to assume other assets, inventories, etc. will cover. Move on to the 10-year financial summary. Any share buybacks? Divide net cash by shares outstanding, and that amount will be the net cash that goes along with every share. Number 12 is some numbers worth noticing. If looking at a specific product from a company, what percentage of sales does it represent? What's the growth rate of earnings? The PE ratio of any fairly priced company will equal this growth rate. Compare growth rate to earnings with dividends. Long-term growth rate plus dividend yield divided by PE. If it's less than 1, it's poor. If it's 1.5, it's okay. 2 or more is best. Check the cash position and value of related businesses. An example he gives is Ford's financing services. Any plans on how excess capital will be used? What's the company's debt to equity ratio? A normal balance sheet is 75% equity to 25% debt. A strong balance sheet is 90% to 10. A weak balance sheet is 20% to 80. What kind of debt? Is it bank debt or funded debt? There's nothing wrong with dividend-paying stocks, but Lynch favors an aggressive grower over dividend-paying stalwarts. Does the business have a history of diversifications? If so, dividends are better than business holding on to excess cash. Make sure the business can pay the dividend. A 20 to 30 year of regularly raising the dividend is your best bet. Also, heavily indebted companies or cyclicals may suspend the dividend. If buying stock for book value, have a detailed understanding of what those values truly are. Assets may be over or understated. Hidden assets. Stock price to free cash flow per share ratio of 10-1 is standard. A $20 stock with a $2 free cash flow per share. A 5-1 ratio is terrific. A company may have modest earnings but good free cash flow. Inventories. With manufacturers or retail, if inventories grow faster than sales, this is a red flag. Make sure the company doesn't have any overwhelming pension obligation it can't meet. Pension fund assets should exceed vested benefit liabilities. Growth doesn't have to come from expansion. Can the business cut costs and raise prices? Growth in earnings, long-term hold. You want high profit margin and low profit margin in a successful turnaround. And then last is just some notes regarding the phases of a growth company. First phase is the startup, which is when it's working out business kinks. Next stage is the rapid expansion, in which it is expanding into new markets. And the last phase is mature, in which there is no easy way to expand. So these are all the notes that I took regarding Peter Lynch's One Up on Wall Street. And this is how I plan to screen the stocks that are in my portfolio. So let me know what you guys think, and then I will start working on that 3M video where I go over all these. All right, peace.